did I pronounce that correctly? Between the Nigerian names and the Italian names today, I don't know if I'm coming right, but I hope I got it close.
Very close.
So welcome. Mark will be moderating the panel on increasing U.S. institutional investment into Africa. So I would like to invite onto stage Caroline Chinhuru from Calvert Impact, Mobola da-Silva from Capria Ventures, James Polan from U.S. International Development Finance, and Amanda Bamberger from Ecosystem Integrity Fund. Thank you. We've got 45 minutes.
Okay.
When you hear the first bell, that's 5 minutes to go.
Okay.
2 bells, you're done.
Okay.
Kicking off the stage, everyone wants to go drink. And then the last thing is we have been having some issues with our mics today. Don't panic. Everyone in the room can hear you. It's a radio interference issue. We can't solve it. So don't panic if the mics are not working. And all the best. Off you go.
Okay. Thank you so much. Thanks everybody for being here, and thanks to my panelists for joining us. I spoke to everybody, or met everybody on the phone. Jim and I are old friends, so it's nice to be here. And certainly thank AFCI for having us. And I realize we are the last folks between now and a drink, so we'll try to keep this snappy and hopefully somewhat informative and entertaining. With that, I'm represented here by really a diverse group of folks that have had long history in Africa, and I think that will be very interesting. I think for this conversation. And let me first introduce Mobola. How are you today? Who has comes from Capria Ventures. Yeah, as I said, a lot of experience up here. Mobola has been 15 years in venture capital with a deep understanding of the African startup ecosystem and a passion for investing. Also, she spent time at Accenture and also at the United Nations Development Program, which I think that would be very interesting to hear how that also how you look at life through that lens, having been at the UNDP. I've spent some time selling to the UNDP, and they really have a grassroots level. And also on the board, or non-executive, on a number of different businesses throughout Africa as well. So that's great. Good to have you. Jim Polan is next. Jim and I have known each other for probably longer than some folks in this room have been alive. We served in the Peace Corps together way back when. Jim, after the Peace Corps, spent quite a bit of time in Botswana, working with the Botswana Development Corporation, if I remember correctly, and then has been with the OPIC, what now is called the DFC, since '95, I believe, right? And holds a degree from the London School of Economics, here in the UK. Good to have you, Jim. Good to see you again, my friend. And then Caroline is a senior investment officer from Calvert Impact Fund. Caroline grew up in Zimbabwe, which hopefully everybody in the room has been to. It's a fascinating place. I've spent quite a bit of time there when I was a volunteer, and I've spent quite a bit of time there over the last few years working on various agriculture projects. And I think Zimbabwe has a huge potential, obviously some serious issues, but I think some significant potential. So Caroline, really, you saw firsthand, fragment development, how fragment capital markets can be, how inefficient capital flows can be, right? So you'll I think, bring a very interesting perspective to this. Caroline now works on portfolio management, deployment across multiple sectors and multiple regions within Africa, and also holds a CFA, which I tried for once, passed first less, and never got further than that. Actually, it's something I always think about and remind my children that they should get one because their father couldn't. And then lastly, Amanda Bamberger, who's just joined us, just got on the panel last couple of days. Delightful to have you, Amanda. Amanda comes is with the Ecosystem Integrity Fund. That's a venture capital early growth fund. And been there since May of last year, but prior to that, spent quite a bit of time in both energy and in sustainable energy now. Amanda holds a degree, both an undergraduate and a master's degree from the University of Villanova outside Philadelphia, and has a master's of science and sustainability, and also studied physics. So we have somebody in the room that probably knows what actually energy actually works versus just throwing on a switch. So thanks everybody for being here. Well, I'm going to ask everybody maybe a question or two, and then from there we'd like to open up to the floor to keep it as informative as possible. Let me start here. And let me just, and so myself, and maybe I'll start here. I've been in Africa. Jim and I, as I said, we've been going back and forth for some 30 years or so. I'm with Rand Merchant Bank. We're Africa's largest bank by market capitalization. I run their office in New York, which is a relatively new job for me. I've only been there for about a year or so. But prior to that, I was a Standard Bank for a number of years and had a similar role. In Africa, I think for everybody in this room, is really it's a passion that we all have, and I think that gets us all here on a weekday in October. For myself, I was going to focus a little bit on equity flows, which have dried up dramatically into Africa, right? When I one of my first gigs in Africa was when South Africa went into the emerging market indexes, and they went in at a 15% weighting, right? So that meant for U.S. fund managers that manage emerging market portfolios that they knew this country was in Africa and probably the southern part of Africa, and that's really kind of all they knew. So we spent a lot of time, working with them, getting them acknowledged both about the country and also about the corporates. That has changed quite a bit over the last few years now. The Johannesburg Stock Exchange has lost about 10 billion rand in market cap over the last 5 years, and lost about 300 companies as well, which is not unique to Johannesburg. The JSE, it's across the board. There are less listed companies, and that in part because there's been such cheap capital over the last 10 years or so. And we think that's going to change, right? So we do think that equity markets are going to become more important as a way to raise capital going forward. And I think that holds good stead for the JSE, but also for other stock exchanges. And if you spend some time with the Ethiopians outside, they hope to have a stock exchange up and running shortly as well. What I thought was interesting for the U.S. perspective here, and this is U.S. investing, I'm sure everyone has seen the most recent news about Chinese investment in Africa, right? It's estimated between 20 and 22. Or 2000 and 2022, there were $170 billion they had invested in Africa, right? What is estimated now in 2021 that went down to probably about 1.2 billion, and this year it's on track to be about 900 billion. I mean, 900 million, maybe a billion. So I think that gives space for the U.S. to get involved, and I've been at this for a while, and I've certainly seen how the Chinese money, and it's done a lot of good, right? But how it's crowded out U.S. investors, and I think that's something that could be an opportunity now for us, for sure. But enough about myself. Let me ask a few questions here of my panelists. Mobola, why don't we start with you? At Capri, you've been active in emerging markets outside of Africa, and I know you've also been looking for the South-South development. So it'd be interesting how on a South-South development, how U.S. investors can get involved in that. And also, what are the lessons that have you learned from other emerging markets, right, that you can bring to bear in Africa and that you can bring to bear for U.S. investors?
Okay. So just as an introduction, Capria is a specialist Global South venture capital investor. So we invest in early stage companies, tech and tech-enabled companies, and we invest across the Global South in Africa, Asia, Latin America, and India. So we've got 5 funds at the moment, and we have just under 200 million under management. So as Mark mentioned, we've been investing in the Global South since the 90s, starting with India. And we recently being, say 5 years ago, started to invest in Africa. And I think in terms of South-South collaboration, I think what's really worked for us well has been our approach, right? So our approach has been to form strong partnerships and relationships with local fund managers and ecosystem players. As a U.S. investor, we are a U.S. fund, we're based in the U.S. We think that's critical. So our strategy involved us first investing in a network of fund managers who are essentially our ears and eyes and feet on the ground. And that was how our strategy began in the global south. And we've only just more recently evolved into making more direct investments, but this is really the cornerstone of our strategy, is having this network of partners, which in turn has resulted in a network of 300 plus portfolio companies, in addition to 16 fund manager partners. And so we've been able to leverage that network, right, in really important ways, right, as a fund manager. So we've got access to, you can imagine the amount of, the wealth of information and data that we have access to. And we really try to leverage that to foster collaboration between our fund managers and our portfolio companies. So we run very intense programs within the network where we get all the companies, for instance, from a certain sector, we call them clusters. For instance, all the companies in agri in our portfolio from the different markets where we invest, to get together and, exchange ideas, troubleshoot, etc., on the things that are going well and not so well in their regions. And it's really powerful because they are in different markets, they don't see themselves as competitors. So, an agri company from Nigeria doesn't see itself competing with an agri company from India. So they are really more open and more collaborative. It really makes for a more collaborative environment. And then in terms of lessons learned, I think the most important lesson for us has been maybe being our approach, being flexible. So again, as I mentioned a few minutes ago, we really started out our life as an accelerator for fund managers, and then we transitioned to being a fund manager, to being a fund investor, a fund of funds, and then transitioned to being a direct investor. And this was sort of a deliberate path for us because we knew we wanted to be in these markets, but we knew we couldn't, as an emerging fund manager, be present in the way that we needed to be to invest in these markets. So our strategy has evolved and changed as we have grown and as we are, find ourselves more able to invest and to serve the markets where we invest the way we want.
Thank you so much. Jim, why don't you hand that to? Jim, so the question for you, obviously this administration, U.S. administration, the Biden administration, has been much more engaged in Africa, right? They had the big event back in December. The First Lady's been here. The Vice President's been to Africa. A number of senior secretaries have been here as well. But I know you've had a long track record, right? Certainly from the DFC and OPIC. So my question would be, because you can be a bit challenging to deal with on occasion, right? What would be the paths of least resistance? What areas you see the best opportunities for, the easiest way to kind of work with the DFC now, right?
Thanks, Mark, and for the backhanded compliment. It's nice to see you. Thank you. DFC is Development Finance Corporation. It's another DFI out of the United States. Just a little advertisement before I answer Mark's question. We have about $35 billion now under management, and we're growing extremely rapidly. In the last couple of years, we've gone from less than 200 people now to over 600, heading to 700 or 800. We hope to grow our portfolio to 60 and then 100 billion in the next several years. We have direct equity. We invest in equity funds. We have all kinds of debt products, credit guarantee products, political risk insurance. Our primary ways to invest. Africa is about a third of our portfolio, so contrary to the movement of capital around the world, we have grown our portfolio in Africa quite a bit. And yes, we're a DFI. Yes, we're a state-owned enterprise of sorts. And it does sometimes take a while if you're looking to borrow, tens and tens of millions. We go from about $1 million to $1 billion. And if you've got a large infrastructure project or a large energy project, it's going to take a year or so before the money's in the bank, most likely, unless you've got all the ducks in a row. But if you're looking to borrow, say, in the 10 million or under range, we do have some programs for that, which are meant to expedite the process. And one of the programs we have is called the Portfolio for Impact and Investment. Our primary goal, of course, is not our bottom line. It's the provision of high impact. And to the extent that we have companies, and this will be of interest, I think, to many of you, that are growing in revenues, that are have really solid investors, and have a rational business plan that we can really get behind. That company doesn't necessarily have to have a profit-making or even an EBITDA-making track record. We've invested about, $700 million in this program, spread out over about 75 companies so far. And that money usually gets out the door in 3 to 6 months, which for a DFI is very, very fast. And it's a place in the middle where companies have a huge problem raising money. And we're very proud of that program. So that's one of the ways that we try and expedite our programs.
Great, thanks. Pass on to Caroline. Caroline, as I said, we have a diverse group up here. Caroline, since Calvert is an NGO, right? That has to present some unique issues and opportunities as well, right? And I know funding can be a challenge at times, and you've actually gone to retail investors to raise funds, which I think is very interesting, actually. I've known another NGO to have done that, which I thought was a fascinating way to raise money. Could you talk a little bit about that and talk about how that transpired?
Sure. So just to give a little bit of background, Calvert Impact has been in the market for almost 30 years now, raising capital from retail and institutional investors for pretty much the entirety or a good chunk of that history. We were spun out of Calvert Research and Management, which was a mutual fund, and so we carried with us a lot of the philosophies that come with that. A key part of our mission is making impact investable. So what does that mean? That means offering a product in the market that the average retail investor can access in a simple and straightforward way, and get access to impact products that might otherwise be inaccessible or only accessible to large-scale institutional investors. So right now we have over 6,000 investors, split out. Most of those by number are retail investors. By volume, obviously, most of our capital is coming from the larger institutional investors. But it's a simple product called the Community Investment Note. It's offered throughout the U.S., and so anyone can go on our website for $20 and get a note. We have people come in $20 million tickets, and so it's a wide range of investors. And a key part of the work that our investor relations team does is education, right? So you don't just need to have a product available on the market. People need to know about that product, and that needs to be a simple and easy to access product. And on the deployment side, which is where I sit, it's important for us to create or to invest in structures that are going to be right-sized from an impact and risk perspective for those investors as well. And so making sure that we're good stewards of that capital, and our track record is a key part of what we leverage when we go out into the market to talk to retail and institutional investors, to get them excited about impact and about return together in this product, and get them flowing into our product. And so it's a long and ongoing journey, and I think as more and more impact products that are similar to ours get on the market, it's become easier in certain ways, because when you're talking to a financial advisor about one single product, it can be hard for them to get on board, because it's well, I have to do all this knowledge and understand this one product, but it's only a single product, not a lot of value for my time. But if there's a portfolio of different products that they can invest in alongside your product, then it's, oh, okay, I'm doing work to understand Calvert's community investment note, but after that I can invest this other note or that other note. And so it becomes, I think it's an ecosystem play, and it's really helpful for the whole community or the whole ecosystem as we get more products like this on the market, and make it easier for regular investors to invest in impact and make impact investing a more democratic process, if you will.
Thank you. Thank you. And Amanda, I know as you mentioned, EFI has a 13-year record in sustainability. I think you might be on your ready to launch your 5th fund coming up. And you spend a lot of time, as we chat about, on next generation, which I think is fascinating, right? I think there's so much that we learned from the cell phone industry, right, and all the changes that have gone there. And from your perspective, right, and the fact that you have a technical background, what do you see as real risks in Africa and perceived risks, and how do you overcome that in your conversations with your investors, with your own credit committee, your own investment committee?
Yeah, thanks. And just a little bit of background on Ecosystem Integrity Fund. So historically, the firm has invested in U.S. clean tech and sustainability companies. Many of the successes of the funds and the funds that have been returned through those clean tech investments. So in solar and in EV charging, a couple of our companies, EV Connect got acquired by Schneider Electric and eMotorworks by Enel. And so there's some precedent, albeit from a different geography, for these types of successes. So EIF, I think, prior to working at EIF, I was at Factory Ventures and spent about 5.5, 6 years with them investing exclusively in sub-Saharan Africa and India. And one of the things that I found really interesting when moving over to EIF is the fact that they pushed their LPs to be able to invest outside of the US. And so in Fund 4, that was a certain percent, and in Fund 5, it's a larger percent than that, more than double. And EIF really sees this as an opportunity to both diversify its approach and also acknowledge that the US isn't as politically stable as perhaps everyone thinks it is, and that there are opportunities abroad that are really exciting and big. And so when we think about like real and perceived risks, I think it's interesting to have lived on, have worked at Factory, let's say, where all of the investments were into Africa and India, and now at EIF, where it's like I look at deals in East Africa alongside deals in California. And in terms of some of the real risks, I think we really have understood, where the rubber meets the road, currency risk is always going to be an issue. And that practically comes down to margin erosion for the company, and then, returns eventually to the equity investor. And so even though, we've had companies have success with the DFC, actually, thank you. One of our portfolio companies has a $9 million facility through the DFC. It's really, when you get that 10% unanticipated change or erosion or depreciation, that hits margins, and then that ends up making it much more difficult for the company to fundraise and to extend its runway. And so I think one of the things that I've been really keen on looking at for subsequent deals is looking for companies that, yes, like we're not afraid of hardware plays, but looking for companies that have like pretty high margins to help de-risk that, and then also looking to participate or invest in countries that have like favorable government policies, especially when it comes to import tariffs. That also helps the companies that are working in e-mobility, for example, to get those commercial tariffs or to get certain things be tax exempt, and that helps a little bit just defray the kind of persistent risk. I think the other thing that is, a real risk is there are so many U.S.-based funds now. EIF is like a classic Bay Area investor that has, done the work to educate itself on different markets outside of the U.S. But there are so many investors in the U.S., I think, who are used to investing in problems that they experience themselves. And I think in investing outside of the U.S., investing in Africa, we have to be observant and students of the market conditions and problems, and acknowledge that our upbringing does not at all reflect what people are going through on a day-to-day basis. And so at least I myself, like, personally spent a lot of time like sitting at a gas station watching boda drivers come in on a certain basis to figure out like, how often do they go to the gas station, and how much money do they have in their pockets when they come into the gas station? Because this is not a concept that like I understand a priori. So I think the risk of looking at the businesses that somehow make sense to us from the US without studying kind of what's happening on the ground is a risk. But in terms of perceived political risk, and I'll finish up here, is I think one of the key things that we've kind of put to the side. We've said, there are plenty of, whether it's corruption or it's policy that influences businesses, there's as much fluctuation and uncertainty in the US as there is anywhere else. And so to think that investing in a company in Kenya or Nigeria, or those companies know how to navigate their own markets. They know the severity of what might be anticipated as political change. Like, you have to trust the companies to know how to navigate that, and also acknowledge that, there could be a change in party in the US government, and that could do away with a lot of the tailwinds for the electric vehicle industry and a lot of other incentives that I think people, fundraise against. So
Sure.
there's a few ideas.
Thanks. And on political risk, right, I like to tell this fact quite often, is that it's more expensive to build a mile of subway in New York City than it is in Paris. And that's because of all the folks that have to be paid in New York when they do some building. It's astonishing fact I always find. But Caroline, I want to ask you another question here, and then have the rest of the group answer it as well. When since you'll have a $20 investor in your funds, right? You have to have obviously a very significant stern commitment. That's, that the off-taker, whether it's an institution or an individual, is going to pay for whatever service or product you're giving them. So how do you institute that? Because I'm the only I'm a commercial investment banker up here, right? And that's a big issue for us, is what is the off-taker agreement, right? There's an off-taker agreement, the conversation with credit can be a lot easier, can be a lot quicker, right? And that's where we struggle from time to time, right? And obviously, if you have, individual investors, that's something you must think about often. Like, how do you get that commitment?
Sure. So the way that our portfolio is structured, so all of our investors are coming in for this one product, and they all have access to sort of the same impact, the same product, the same investments throughout our balance sheet. So where I sit on the investments team, we're identifying opportunities in the U.S. and emerging markets. So we have about a $500 million portfolio. Half of that is in the U.S. and half of that is in emerging markets. And as we're looking at emerging market transactions, we're managing sort of two things. We want to make sure that we meet the return target goals that we've set for our investors. It's a fixed income product, so we have an interest that we're paying them on a periodic basis, and then there's a term, either 1 year to 10 years, where we have to pay back that principal within that period of time. And so we're identifying, products and funds on the emerging market side that are going to help us meet those goals. And I think on this side, the blended finance model has been a key workhorse for us because it's allowed us to access, products and segments of the market might be a little bit too risky for us to look at, or a little bit more volatile. I'm talking about things like currency volatility. That's not something that our investors, or the type of investor base that we have, is going to necessarily be able to absorb. And so we want to make sure that we build a balance sheet that's protected against those types of volatilities and risks. And so going into structures where if we have a significant portion of local currency exposure, we also have a mitigating amount of philanthropic capital built in, so that we can manage that risk and manage that downside risk. But at the same time, we want to be investing in strategies that ultimately are going to be sustainable for the markets that they're supporting. And so as we're looking at the fund strategy, we don't want to be in a fund that's going to come in and provide very, very cheap capital that once they disappear, that market is not going to be there anymore. We want to be going into fund structures where they're going into the market, they're creating markets, they're providing capital that's right sized and right priced for those particular markets. And we can see it from sort of their interactions with their borrowers. We spend a lot of time understanding who they're working with, how they're working with those communities, and it ties in with pricing and the commercial aspect of it, but also ties into impact. Because the more in touch our fund managers that we're working with are with their communities, the more likely they are to be delivering on the impact targets that they've said they're going to meet, and that we've told our investors they're going to meet with their capital. And so it's working with those structures, really working creatively with different sources of capital to create structures that are going to help us manage risk, meet the return profile deliver on.
And Jim, from the DFC perspective, how much you must look up the off-taker, and do you do that? I know you spend a lot of time, your team spent a lot of time on the continent. Do you do that research yourself, or do you depend somewhat on, if you're working with another commercial bank, do you look at what their credit committee has put forward? Yeah, how do you make sure you're going to get paid back?
Yeah, that is the question. Well, we don't have off-takers for most of our deals, except for the infrastructure. And in fact, even in the infrastructure, we do an analysis, and 90% of the work is done by us. And when there are very large deals, of course, there's enough money floating around to hire large consulting groups to do to analyze historical markets for commodities, if that's what we're doing, and project into the future. And then, of course, we're going to take the haircut and figure out whether we're going to get our, what the odds are that we're going to get our money back. But on a large part of our portfolio, particularly the impact, high growth, these days, fintech, ag tech, health tech, edutech, all of this stuff, it's market. And the off-taker is not contractual. And we are, using more and more blended products. We work with Calvert quite a bit. So all of us, I think, we're working together. And I think the future of our impact side is to understand that we are a development finance institution, and we are in business to produce impact and not bottom line returns, which, to some of my colleagues might be a controversial statement, but that's fine. I've been around long enough, doesn't matter to me. But if we break even, or even in over a 5-year period, a couple of years, we come out negative, but we produce significant impact in all the ways that we mean that, jobs and education and basically livelihood improvement in the countries we're operating in, I think that achieves our goal. And I think, risk mitigation is the answer to perception. Because I don't think we at DFC are going to change decades-old perceptions of risk in Africa. There are a ton of agencies in the world and in the United States alone that portend to do this, to tell the stories of why and those are great, but at the end of the day, companies are going to be looking at whether it's a high or a low level of risk they're going to take. It's all perception until they get in the markets. And I agree that, if you're going to make an investment in Utah or you're going to make an investment in Kigali, there's a bunch of risks. And we are there to try and mitigate through all the different products that we have.
Very good. And on risk, a couple of different areas here, because I've often thought from a credit perspective we should do more about this, is with AI. And Mobola, I know you've been involved in AI. And how can you see that play a bigger role? Because we'll look at investments, and I say, we're just looking at, maybe this hasn't happened in the investment, maybe it's unique in Africa, it hasn't happened in Africa, but I always say, this must have happened in other parts of the world, right? Can't we get that data and see how that worked, right? And granted, Africa might have some unique issues, and at the same time, it doesn't have some unique issues at all, right? And I think one thing I've learned from multinationals is, they go in and, with all the power issues that they've had in South Africa, you call up and say, what do you think about power? I go, no, we have a whole group of people that worry about power when power goes down in the national grid. And you call them up, they sit in a different division, they can kind of figure it out, right? So some of these issues aren't unique. But I think that if you could capture better AI, how these companies are managed this globally, and have that come to bear on Africa.
So I think that you've kind of touched on what is really behind the power in generative AI. And thank you. And I think that is the ability to the ability to use or to build on the large language models that are being built by a handful of companies. to build solutions on top of that that provide access to information that was previously just generally inaccessible or in, you know, sort of like silos and fragments, right? So drawing that information, all of that together and giving access to, you know, the regular people and small businesses and startups, you know, alike alongside big companies, etc., is really transformative. And so for Capria, the way we see AI and its impact on emerging markets in Africa and where the other markets where we invest is we think it has the potential to really be transformative in these markets and creating new opportunities. And the lens through which we frame that is along 3 lines. So the ability for generative AI to be an equalizer in terms of language and in terms of talent, right? So prior to now, in some markets, you could only get information in English, right? And that's, you know, that's a constraint in markets where multiple languages are spoken, right? You could only access information in English, right? So for instance, learning information was mostly in English. With generative AI, you know, I think at the moment we're up to 100 languages that can translate, you can translate using generative AI. So it's equalizing language and talent, right? So having people and companies, so again, these capabilities were, you know, in the past only available to large companies, etc., governments, but are now generally more accessible. Another area where we think generative AI would be transformative is in opening up new markets. We call this TAM expansion, total accessible market expansion, right? And that is because in emerging markets, there are markets, opportunities, areas, etc., that have hitherto been too expensive to serve or too inaccessible, right? And we really see that with AI, the potential to open up new markets. So the unit economics or operating economics of these markets are suddenly become more attractive. And then, you know, that creates more opportunity and more, you know, investable companies for VCs, investors like Capria. I'll stop there.
Okay. Let me, that's a 5-minute mark, and as I said, I know we're between us and some drinks, so why don't we open it up for any Q&A?
Hi, thank you all. My name is Taslim. I'm from Senegal. My company develops sustainable infrastructure in Francophone West Africa. One of our key issues right now in terms of being able to be as impactful as we'd like is capital constraints. So I have a question which might be a bit, I don't know, I'll just ask it. Do you feel like in Africa there's a path towards as sophisticated financial and capital markets as we have in the US in particular? Like all these various players that have, you know, like you have the pension funds, the mutual funds, the hedge funds, et cetera. Is there a path for Africa to aggregate and mobilize local resources to be able to hedge some of these risks that you guys are talking about when you come from the outside? And my second question is particularly for the DFC, how do we get, how do we submit a need for capital?
Jim, before you answer, I've been, you know, involved in the equity markets for a long time, right? And there's long been talked about regional stock exchanges, and those conversations end pretty quickly when they find out it's not going to be in their country, right? So, you know, when they get beyond that it's a regionals, that means only one country. It's only going to be in one country. You know, that could change it. And I think there's, as I said from the beginning, I think there's an opportunity to do that because I think equity markets are going to play a much bigger importance in capital raising than they have over the last 10 years or so. But Jim, do you want to?
Thanks for the question. I love Senegal, by the way. We're doing some good stuff there, I think. So in infrastructure, that's a tough one. We do have a priority infrastructure program. We're moving to a sector-based organization from what we had before, and one of them is infrastructure. And what we are providing is, you know, our normal infrastructure long-term debt, usually. Now, these are typically, they might be roads, toll roads, or ports and airports. And we're looking for off-takers that, in the case of Senegal, it would be the state-owned enterprise. And we're starting to now, one of the problems with financing infrastructure from a DFI is a lot of us aren't permitted to invest directly into SOEs. And if we could do that, I think there'd be a whole new world opening up in the provision of capital for these infrastructure projects. Our new law at DFC, our statute, if you will, does not prohibit us from doing that. Now, there's politics and policy behind it, and we are looking at development banks that are state-owned to provide direct finance to. And if I get my way, we'll be doing some large infrastructure where the state actually has an involvement, direct financial involvement. Most of my colleagues aren't there, and I hope to help, institute this kind of thing, because it takes decades for SOEs to devolve. Some countries do it faster than others, but some countries keep the reins for very good reasons, because they're just not ready yet. The other thing that we hope to do is the amounts of equity that are needed on these billion-dollar projects kind of prohibit us, because we can't really do much more than a $50 million ticket on equity, which isn't going to get you that far in a big infrastructure deal. But if we get permission from our stakeholders and the right kind of resources, then we'll be able to do more direct equity in infrastructure, which will then, of course, with the DFC as a substantial equity partner, I think the rest of the financing.
Great, and I think it was another question?
Yeah, I'm a VC myself, and I observe a great need for debt within our portfolio. However, interest rates, when I go out to raise that debt in the U.S. are SOFR plus 15. And Caroline's comment around right-sizing investment structures for the markets really stood out to me, because there is a lot of subsidized debt in Africa, particularly in East Africa, where we deploy our capital. And I get the reaction from founders very often, 15 to 18%. No, I'm not interested in that. But I can't create a product with investors coming into it. So I'm honestly curious about if any of you have encountered this, what you think the solution is, because I'm emphatic, that we provide the asset financing and the debt that our companies need, but it's very hard for me to sell it.
Sure. Does anybody want to tackle that? Caroline?
I can take a stab. I think it's a hard and long process, because we kind of all have to get behind it for it to work in terms of all provide capital that is right-sized for the risk and return of particular markets. Now, we talked about perceived risks, and so there are markets where there's a gap between the real risk and the perceived risk, and I think that's where lower cost capital can play a role in coming in and showing, actually no, this market, it's not as risky as we think it is. We can make the products work at a lower return and get other capital coming in after them. And then there are other markets where that's not the case. The perceived risk gap and the real risk gap is a little bit narrower. And I think it's education. And I think ultimately, unfortunately, a lot of there's a limited pool of lower cost capital or more philanthropic capital. And at the end of the day, as a lot of these companies scale and grow, it's an education process that they have to go through, that we all have to go through to get to a place where we understand, if we want to continue to grow, the next dollar is going to be more expensive. But it's long and it's hard and it's a painful process.
Okay, I think we're. I think it's cocktail hour. So thank you everybody for your time. Thank you for having us, FCI having us. And I know myself, I've done this for a while, but I learned some things today. So hopefully everybody did too. So thank you very much for the panelists. I think it was a great group.
Thank you so much, Mark, and thanks to Caroline, Mobola, James, and Amanda for a very insightful discussion. The investment track does continue tomorrow. I'll be moderating in the morning again, chairing the session. Please join me at 9 o'clock, and until then, enjoy your drinks and networking tonight. Thanks so much.
Thank you so much.
Yeah, good to meet you.
Nice to meet you.
Yeah,
Okay.
have a great evening.
So do you
No, no. About